Based on analysis from major crypto firms and financial institutions, Bitcoin is expected to enter a transformative phase in 2026. The overarching theme is a shift from retail-driven speculation to a market dominated by institutional adoption and structural maturity. Rocket key bullish catalysts for Bitcoin in 2026. 1. Institutional capital goes vertical. Institutional investment is predicted to accelerate sharply, becoming the main driver of the market. Spot Bitcoin ETFs have already established credibility, and their growth is far from over. Grayscale estimates that less than 0.5% of U.S. advised wealth is currently allocated to crypto, suggesting enormous room for growth as more financial platforms complete their due diligence. Reports indicate that major banks like JPMorgan are preparing to offer services such as accepting Bitcoin as collateral, further cementing its role in mainstream finance. 2. Digital gold and monetary demand. A major theme is Bitcoin's role as a hedge against fiat currency risks. Grayscale and others point to high and rising public sector debt as a catalyst, driving demand for scarce digital commodities like Bitcoin. This digital gold narrative is expected to attract sustained investment from sovereign wealth funds, endowments, and even nation-states. 3. The end of the four-year cycle. Multiple firms, including Grayscale and Bitwise, predict that Bitcoin's historical boom and bust cycle will soften or break in 2026. The market's maturation, lower volatility, and steady institutional inflows are expected to lead to a more stable advance. While dramatic surges are less likely, the probability of a deep, prolonged crash is also seen as low. 4. Potential price predictions. While opinions vary, the outlook for Bitcoin's price is generally bullish. However, the forecasts show a wide range, reflecting a high degree of market uncertainty. Primary price targets for 2026. Bullish scenario, $200,000 to $250,000, Galaxy Research, Fundstrat. Median estimate, $170,000, JPMorgan. Conservative scenario, Bitcoin ends the year lower, Gemini. Notable context, options markets are pricing an equal chance of Bitcoin being at $50,000 or $250,000 by the end of 2026, highlighting the extreme uncertainty. Grayscale expects a new all-time high in the first half of the year. 5. Regulatory clarity and political embrace. The U.S. regulatory environment, which saw a decisive shift in 2025, is expected to solidify further. The bipartisan Genius Act for stablecoins laid the groundwork, and analysts from Grayscale, Nasdaq, and Gemini anticipate that comprehensive crypto market structure legislation could pass in 2026. Crypto policy is also expected to be a major issue in the 2026 U.S. midterm elections. Risks and market evolution. 1. A less volatile, more boring Bitcoin. Analysts note that Bitcoin's price action in 2025 was uncharacteristically flat, ending roughly where it started. This range-bound behavior is attributed to institutional participation smoothing out extreme swings. Bitcoin's volatility has decreased structurally and may even fall below that of stocks like Nvidia. Changing investment strategy. Given the potential for lower volatility and uncertain short-term price movements, many analysts recommend a dollar-cost averaging strategy for 2026. This involves buying a fixed dollar amount at regular intervals to mitigate timing risk and accumulate assets through market dips. Broader market themes for 2026. The transformation extends beyond Bitcoin. Here are key trends that will define the broader crypto market. Stablecoins become the internet's dollar. With clear federal regulation via the Genius Act, stablecoins are poised to surpass legacy payment networks like ACH in transaction volume, becoming integral to global commerce. Accelerating real-world asset tokenization. Tokenizing traditional assets like stocks and bonds on blockchain is at an inflection point. Predictions include a major bank accepting tokenized equities as collateral and the SEC providing regulatory relief for tokenized securities. Continued industry consolidation. A wave of mergers and acquisitions is expected as companies race to build full-service crypto banks and digital asset treasury firms consolidate. Prediction markets go mainstream. Platforms like Polymarket are evolving from niche experiments into durable financial infrastructure for information discovery, with their relevance boosted by the election cycle. In summary, 2026 is seen as a foundational year where Bitcoin and crypto shed their speculative skin. The focus will be on institutional adoption, monetary utility, and real-world financial integration rather than short-term hype cycles. While price predictions are wide-ranging, the structural shift toward a more mature, regulated, and integrated asset class appears to be the dominant and most authentic narrative. Genius Act and the operational mechanics of asset tokenization. These are the two pillars set to fundamentally reshape the crypto and broader financial landscape in 2026. The mechanics of stablecoin regulation, the Genius Act framework. The guiding and establishing national innovation for U.S. stablecoins, Genius Act, signed into law in July 2025, is the first comprehensive federal regulatory framework for stablecoins in the United States. Its core purpose is to transform stablecoins from a market experiment into regulated financial products by establishing clear rules for who can issue them and how they must operate. Permitted issuers. Only approved entities, known as Permitted Payment Stablecoin Issuers, PPSIs, can issue stablecoins for the U.S. market. These include subsidiaries of regulated banks and non-bank entities approved by the Office of the Comptroller of the Currency, the OCC. Legal clarity. A compliant payment stablecoin is explicitly not classified as a security, resolving years of regulatory uncertainty. The law enforces stability and trust through several stringent, mechanics-focused requirements. Reserve backing. Issuers must hold high-quality, liquid assets like cash and short-term U.S. Treasuries equivalent to 100% of the stablecoins in circulation. These reserves cannot be used for other purposes, hypothecated. Redemption rights. Holders have a legal right to redeem their stablecoins for U.S. dollars on demand. Issuers must have a clear, publicly disclosed redemption policy. Transparency and audits. Issuers must publish monthly reports on the composition of their reserves. These reports require independent certification by a registered accounting firm. Compliance duties. PPSIs are treated as financial institutions under anti-money laundering laws, subject to Know Your Customer (KYC) and other banking standards. A stablecoin that does not meet these requirements faces significant restrictions. For example, starting in July 2028, crypto exchanges will be prohibited from offering non-compliant stablecoins, and they cannot be used as cash-equivalent collateral in regulated financial markets. The core mechanics of asset tokenization. Asset tokenization is the process of converting ownership rights to a real-world asset like a bond, a share of real estate, or a piece of art into a digital token on a blockchain. Unlike simple digitization, tokenization makes the asset programmable, divisible, and easily transferable. How it works, a step-by-step process. The technical and legal process typically involves several key stages: asset identification and legal structuring. The real-world asset is identified and often placed within a legal entity, like a trust, to link token ownership to legal rights. Digital representation creation. A digital token is created on a blockchain. Its underlying smart contract code is programmed with essential information, the asset's details and ownership rights, including entitlement to dividends or interest, compliance rules, for example, who is allowed to hold or trade it, and the asset's transaction history, provenance. Token issuance and management. The tokens are minted and distributed to investors. From then on, all transactions, income distributions, and other functions are automated and executed by the smart contract. Key benefits enabled by these mechanics. This technical foundation unlocks transformative advantages. Operational efficiency. Transactions can settle in minutes or seconds instead of days, a process known as atomic settlement, reducing risk and cost. Fractional ownership. A single high-value asset can be divided into many affordable tokens, democratizing access to investments like commercial real estate or fine art. Enhanced liquidity. By making assets easier to divide and trade 24/7 on digital markets, tokenization unlocks capital in traditionally illiquid markets. Transparency and automation. An immutable record of ownership and automated compliance via programmable rules reduces fraud and administrative overhead. The interplay and future impact. These two innovations are deeply interconnected and will drive the market in 2026. Stablecoins as the digital dollar for tokenized markets. Regulated stablecoins, operating as predictable digital cash, are expected to become the primary medium for buying, selling, and settling tokenized assets. The Genius Act provides the trust needed for this role. Tokenization as the killer app. Major financial institutions like BlackRock, JPMorgan, and Fidelity are already piloting tokenized versions of assets like money market funds, bonds, and private equity. Analysts project the value of tokenized assets could grow from hundreds of billions to trillions of dollars by 2030. Persisting challenges. Despite the progress, full mainstream adoption faces hurdles. Regulatory patchwork. While the Genius Act covers stablecoins, comprehensive U.S. federal rules for other tokenized assets, like securities, are still developing, creating complexity. Technological integration. Bridging private permissioned blockchains used by institutions with public ecosystems remains a technical and procedural challenge. Operational risks. New considerations around digital custody, cybersecurity, and tax treatment for on-chain transactions require new expertise. In summary, 2026 is poised to be the year where the foundational rules, the Genius Act, and the foundational tools, tokenization, converge. This will move the crypto narrative beyond speculation and toward practical rebuilding of global financial infrastructure. I hope this detailed breakdown is helpful. If you would like to dive deeper into a specific application, such as how tokenization is being used for real estate or private equity, I can provide more focused information on that.